All right, so we've got more questions today. A lot of really good questions from a person named Jury, if I'm saying the name right, who emailed me a couple days ago asking me. Now, a lot of these questions, before we get into them here, they sort of hinge around the topic of how much trading capital do you have and how much trading capital do you need to trade successfully. Obviously, you can trade with your own capital, whether that's $100 or $100,000. Or you can use something like a lot of these retail prop firms. As a lot of you guys know, I started a $150,000 combine on Top Step, and it's a futures account. I'm just trading ES&P futures. The account's up $700 right now, and the P&L yesterday was about $400. I'm doing this live in the Nick's Trades group. I'm still calling out Forex trades. We're in a profitable Euro USD trade, which has since gone into more profit from here. And since Forex trades don't take that much time, every day I'm sending out a Zoom link and we're just trading futures live. So for now, that's what we're doing. These are all the trades and the trade history in case you want to screenshot this and see. The spreads are virtually zero. The fees are very little. And I'll point out that in order to do all of this, it's only $150 a month. So while I'm not affiliated with Top Step at all, and while I'm still going to see how well it works or the lack thereof, I will keep you guys updated. But this is the idea that you can have access to about $4,500 of trading capital, since that's the drawdown limit, with only $150 per month as a subscription fee. So let's read the first question from Jury and see how all this relates. So the first question, he says, how much do I allocate to trading capital? Assuming that the average person works an average job, how much money per month does he need to allocate to savings to build trading capital in 2025, and how much should he save up before he starts trading? So this is a very, very subjective question, and I think it really depends on a couple things. The first thing it should depend on, almost in its entirety, is your risk tolerance. Okay, regardless of whether you make $100,000 a month, $100,000 a year, or maybe only $25,000 per year, the amount of money that you're willing to lose, that should be your risk tolerance regardless of your income. Now, of course, there are some exceptions here. You could be a person who barely makes any money, but you have zero risk tolerance and you're perfectly okay with risking all the money you've made for the year, gambling on some sort of Forex trade in which you're using the maximum position sizing you can and just kind of letting it play out. You're essentially playing blackjack at the casino at that point and putting everything on red. And I don't think that that is the best way to approach it. However, there are a couple parameters here. So here's what I like to do. I have usually a couple $100,000 cash that I keep in the bank. And I just use that to just pay personal expenses and bills and stuff. That means that if I have a slow period of trading or a slow period of business or even high unexpected expenses that come up, as they often do, I have plenty of cash and I don't have to worry about my investment capital. The problem is when a person takes the money that they're wanting to invest and then they combine that in the same sort of mental account as their personal capital that is used to pay expenses. Now, this gets really, really difficult to try to reconcile, because if you need the money to pay your expenses, but it's in your trading account, well, now you start doing a lot of things that really don't make a lot of sense. For example, you might start entering trades that don't really align with your trading plan or trading style or intuition, because you're just quickly trying to make some money, desperately hoping something's going to work out so that you can increase the account balance just a little bit to then withdraw it and then be able to pay a bill or something like that. That's obviously not very conducive to profitable trading long term, because you're thinking too much with the negative side of emotions instead of the positive side of emotions, which is essentially just that feeling you get when you think price is about to go up or down, that we just call intuition and discretion. And that's born of getting a lot of experience trading. If you're using that, it's fine, but if your emotions are discursive and negative, then yeah, it really does impair your judgment, and I don't think that's a good way to go about it. So let me give you an example here for what I think is reasonable. And Jury, I think this will probably help you, in my opinion. And if not, feel free to let me know in the comments. Anyone who thinks that it isn't useful or needs more context, I'm happy to help. So jury, let's say that you make $4,000 per month, or euros, or GBP, or AUD, or whatever currency you are in the world. Say you make $4,000 per month. Now let's say about 1,000 of that is tax. So now you're left with $3,000 per month. And then let's say your expenses are $2,000 per month. So now you're currently left with about $1,000 in discretionary disposable income. Of what's left after paying all tax and all bills, I think you really need to ask yourself how much you're comfortable risking, okay? There's no right or wrong answer here. There are no absolutes in trading. Everything is purely subjective, and it is all open to interpretation based on your subjective judgment. If you are comfortable risking only $500, that's fine. There's nothing wrong with that whatsoever. All that means, though, is that it means that you need to just put that into an account and nothing else. Take me, for example. The trading capital that I have in total is allocated to a couple $100,000 cash for expenses, and that stays in my bank accounts, getting like a stupidly low rate of interest, which I'm not too concerned about. And then on top of that, most of my trading capital, let's say 90% of my entire net worth, is currently invested. And it's invested in 3 market asset categories. One of them is cryptocurrency, in which about half of my investment capital sits since Bitcoin has gone up so much. About 25% of it right now sits in equities, and 90% of that is in the S&P 500. The other 10% is just cash in the account for discretionary buys and sells. If the S&P crashes a lot in a week or two, I can buy, and if it bounces up, then I can trim the position back out. And then the other 25, the final 25% of that sits in Forex, that is allocated to Forex trading. So with the capital that's allocated to Forex trading, I usually don't put any more than about 10% into a trading account. So for example, the current account that I'm trading on right now has about $179,000 in it, so $180,000 in it. So this right here is about maybe 15% of my Forex trading capital. Right now I have just over, I think it's like 1.25 million allocated to FX. That's how much I'm trading with. That's how much I'm comfortable risking in FX, and I just put a small portion of that into an account. So generally hangs out around 10% plus or minus. Sometimes it's 5, 8%. Sometimes it's 12 to 15%. So with that, that's what I'm comfortable risking in Forex trading. Now, jury, you may feel different, right? You may obviously just not have that much money to put into an account, let alone that much trading capital in general. But the amount of money that you should risk is something that you should be completely comfortable with. And if you're not 100% comfortable with losing the money that's in that trading account on some unforeseen black swan event that could happen that could cause the entire account to blow, then you don't need to be putting any more money in that account than you're willing to lose. I think that regardless of the amount of money someone makes, they should always consider this question, and your entire risk structure hinges upon how much you are truly comfortable risking. The second, can I scale winnings exponentially? How long does it take? I'll just go ahead and stop right here, and we'll just address this first. Can you scale winnings exponentially? Now, the answer is yes, but only up to a point. A lot of brokers will have maximum position sizes that you cannot go past. For example, a lot of brokers will have a maximum of maybe 100 standard lots, maybe 200, maybe 500 standard lots that you're allowed to be in at once. And provided that you are trading on a live account, you cannot go over that amount, because if you do, then the broker will prevent you from entering more positions. This is done for a couple reasons, but in short, all this means is that you can scale winnings exponentially up to a point, at which point you cannot use any bigger of a position size, unless, of course, you start talking about having some type of institutional account that large funds use in order to trade things like Forex with and other asset categories. In those cases, you can have liquidity providers and certain types of brokerages in-house that can allow the fund to trade higher than that, obviously. But for retail traders, you can't scale your winnings exponentially past a point. But up until then, sure, and you can make more than enough money doing that. How long does it take? This is a question that depends on so many things that it's not even really worth getting into. And that may sound like I'm running away from a question here, but if I told you it were to take 1 month, then you would have that expectation in your head that it would take 1 month to do. If I were to tell you it would be 10 years, then you would be having it in your head that it takes 10 years to do. Now, obviously, needless to say, could it take a month? Sure. Like there's been times where I've grown a $50,000 account to $100,000 and it only took 3 weeks back in 2022. I did this live in what was called the Mission FX Close Friends group, which was just a group where I was trading live. The Mission FX Nick's Trades group now, that subscription, that's now taken over as my bona fide de facto trading group. But back then I had done that back in 2022, and how long did it take? 3 weeks. Now there's also been other accounts where it's taken me like 5 months to double it, from like 100K to 200K, or from 50K to 100K or something like that. How long does it take? It takes the range would be so wide that it would just be pointless for me to even give a rational response to this. I'll also point out, Jury, that if you're asking this question, for most people, most of the time, it means that you might be having expectations that are just a little bit unrealistic. This is like me going and talking to somebody about losing weight. And let's say, for example, in some adjacent universe, I was 400 pounds and I wanted to lose weight and get to 200 pounds. And I asked my trainer, how long does it take? Well, that's going to depend on so many things, such as my metabolism, such as my diet, such as my exercise, how much I'm willing to actually sweat, and how much water I'm drinking, and the macros and micros I'm consuming. It depends on so much, and it also depends on whether or not you're using any type of performance enhancing drugs. In this case, it wouldn't be steroids. It'd be something more like semaglutide, like Ozempic, to help control cravings so you can lose weight. But all those things really factor into it, and it's not really a beneficial question to ask how long does it take. If I want you guys to take anything from this at all, it is the fact that you shouldn't really worry about how long it's going to take to grow an account, because if you're asking that question, it might just put improper expectations in place that just hold you back, and I just don't think it's that healthy. So, moving along, is it possible to grow a small account from $500 to around $10,000? The answer, in short, is yes, it's possible. And if so, is there anything special that the trader should do, or is it all going to come down to luck? We're assuming the trader has more than $500 in capital, because it may take a few tries, and that trader isn't new to trading. Note, I'm talking specifically about reinvesting winnings and not adding anything to the account past the initial $500. Is it all going to come down to luck? Well, certainly a portion of this equation would come down to luck. There's been times where I've taken a $500 account to $5,000, and there's been times where I've taken a $1,000 account to $10,000 a couple times, and there's been also multiple times I've taken a $3,000 account to $20,000. So, is it possible? Sure. But in the midst of me doing all that, I had also blown a significant number of accounts doing so. So it's not like just growing the account to that growth target is going to represent all the profits. For example, say you start a $500 account and try to take it to 10K, but you blow the first 6 accounts, right? So now you've lost $3,000 and you grow the final one to $10,000. And so with that, you're left with like $7,000 minus your initial investment. So you're really left with $6,500. Then a lot of us have tax implications. So really you're left with $4,000 that you can actually go and spend. And that's after blowing 6 accounts in a row and only growing 1. So is it possible to do? Sure it is. If you're focused on trying to do this, what this generally tells me, Jury, and this is no fault of your own, it just tells me that you are trying to make a lot of money with a small amount of money. And I think that what's more important to focus on first is just getting profitable to begin with and not worrying so much about actually compounding an account very quickly. I'll give you an example here, and maybe this will resonate with a lot of you guys. The average deposit for an unregulated Forex broker is about $300 US. $300. This is next to nothing in the grand scheme of things in the trading niche. Okay. You have certain hedge funds that have billions of dollars in assets under management. and you have people that are just trying to make their lives better and learn trading, approaching it in perhaps misguided ways, depositing about $300 into a trading account in which they're virtually guaranteed to lose. And the reason is because there's a lot of people depositing their $300 into an account, and it is their only $300 account, right? And we're not assuming that the trader has more than that in capital, like you suggested, Jury. What we're saying is that is all the money they have to invest, and they don't get to refund their account until they get their next paycheck, which is perhaps 2 weeks to a month from that time that they make the initial deposit. These are the kinds of people that are trying to learn how to trade Forex. And now, while there's inherently nothing wrong with this, there is something inherently wrong with the expectation that comes with trying to deposit a small amount into an account and then grow it very quickly. I'll give you an example. If I can even get a 10 to 15 to maybe even a 20% return on capital per year in just Forex, let alone crypto and stocks, I have had an amazing year. However, if I were to tell you, Jury, that growing your $500 account to, let's say, like $600, if I were to tell you that that is an amazing return, you would look at that as only just net $100 of profit, and then on top of that, that's a 20% return. Now, if you were doing that with structured and controlled risk for every single trade, and your account balance never dipped below, say, the 10% mark in drawdown, and you were able to come out 20% on the year, even with winning and losing and break-even months, that is amazing. As a matter of fact, that's phenomenal. But most people don't care about making $100 for the entire year, even if it's something that almost no one can do. A lot of people, by no fault of their own, want to get rich quick. As ridiculous as it sounds to say out loud, most people actually think this way, and most people actually have that belief that it's not only possible, but that it's probable. What I am saying here, Jury, is I don't think it's a good thing to focus on. I don't think, even if it's possible, that trying to put $500 into an account and growing it to $10,000 and how long that will actually take and being focused on questions like these is a healthy way to actually make money trading long term. I think what's more important is just to start a demo account, get plenty of experience over the course of 6 to 12 months, and once you have something that seems to be working, starting a live account with whatever dollar amount you like, with very low risk per trade, so that way you don't lose all your trading capital, and just seeing what happens on the account. If you're able to just break even, you're doing better than 90% of traders over the course of a 90-day period. If you can get to the end of that, just having not lost anything, let alone making a profit. I know I may sound like a doomsdayer here, but these are the realistic expectations. Most people lose money trading because trading is inherently extremely risky, and most people are simply not cut out for it. I think a big reason for that is poor expectations. Hopefully, with my answers to this second question you asked, Yuri, I was able to shape your expectations in a little bit more of a healthy way, as well as all of you listening. So number 3, what's the best PC setup for trading? I notice you trade like 5 or 6 different things at once, since you do hands-on trading aggressively adding to winners. Do you use multiple windows, monitors, etc., or do you rapidly switch between tabs? So I do 90% of my work from either my phone or my laptop, which is a 2023 MacBook Pro 16-inch with whatever new processing chip they had just made at that time. And it works great for me. I mean, I've never really had a problem with this computer. I don't have multiple screens. It's not hard for me to manage multiple trades at once. For example, right now I'm only in Euro USD and nothing else at the moment. Whenever I'm scalping futures, if you would call it futures, I will say day trading futures, since scalping has a kind of a poor context with it. But when I'm trading futures, I'm just looking at one thing at a time. I'm not generally trading a million assets at once. Sometimes it might be 2 or 3 if it's Forex, but they're not hard to manage because they're all based on higher time frames. So even if I only checked it once or twice per day, that's more than enough time, and one screen is more than enough to do so. So that's my current setup. I don't have to rapidly switch between tabs because in TradingView I can just click from pair to pair and everything's perfectly fine. All right, so number 4. Is it better to perform hands-on trading adding to winners, or is it better to take it as a set and forget approach? So the answer is both, but they should be done in a sequential order. So the first thing I generally suggest is that people start with just using a sort of set it and forget it approach. Now this is just to say, get into a trade that you think price will go up or down in, figure out where you'd like to enter, where you want to place the stop, and then just place the target at a 1-to-1 risk-reward ratio. Now, there's a reason for this. The first thing is that if you're just entering random trades, you are probably going to break even. Quite literally, just buying and selling wherever you want, with a stop wherever you think is reasonable, and it doesn't really matter, it's just whatever you think, and a target at just 1-to-1 risk-reward ratio. All this means is that half the time price will move to the stop loss location, and the other half the time price will move to the take profit location. And if you're doing this, you will break even net of fees and commissions, which are very small if you're using an unregulated broker. And spreads and swap fees are not something to be concerned about either if you're using a broker that has high leverage and low fees. This teaches you that without even having to try to predict where price is going to go, and just simply flipping a coin and buying and selling with a 1-to-1 risk reward ratio and letting it hit the stop loss or profit target, this just means that long term, given enough trades, you do need a large data set, at least 100 trades. If not, it's better to have 200 to 300 trades to really let random distribution play out. But you're just going to break even, okay? Just statistically speaking, most people are just going to break even net of fees and commissions after doing that. And then after you start getting experience, seeing how arbitrary the price movements are and how, little you truly can predict where the markets are going, then you can start having a system where if you get into a trade and then it starts to go against you, you can reanalyze and then perhaps decide to close the trade early. So instead of losing what the full stop loss is at 1 unit of risk, you only lose maybe a fourth of that or half of that. And this means that your losses will be kept small because the worst case scenario, you lose whatever it was you originally decided to risk on the trade. But more often than not, you can get out of the trade early if it starts to not work, and so you lose even less than that. The 1-to-1 risk reward ratio then just becomes kind of like an emergency stop loss location, just in case it goes against you really quickly, goes all the way there, cuts you out of the trade, and you lose 1 unit of risk. Then what you can also do is if price does in fact start going into profit, then what you can do is you can just simply add to that winning trade. And if your original stop loss was a 1-to-1 risk reward ratio and it was very far away from current market price, then you can have essentially the same entry for your second trade. You just have a slightly shittier entry and a slightly closer stop loss than the original stop loss. But it's more or less the same trade, and you can move the stop to break even for the first position, and then you don't have to worry about where price goes after that. I'll give you an example. On Euro USD, let's say that you had sold up here. When price made a new high, you had entered a sell or something like this. Let's say the original target was somewhere far below, and the original stop loss was up here at a 1-to-1. What you can do is after you're just letting the trades hit the take profit or stop loss for an extended period of time, just to gain experience, what you can then start to do is if price begins to move into profit, you can start adding to it. Now, what does this look like? All this looks like is you simply just copying and pasting the same exact trade, but you do it just a little bit lower from wherever price is at. So what happens is you'll notice that this right here was the first trade. This right here is the second trade. And even if this first one gets stopped out at break even, because you should always move the stop to break even whenever you add another trade using this risk structure, even if that gets pinned out at break even, you're still sitting in roughly the same trade because the original stop was far enough, in this case about 150 pips. The beauty behind this is that with the same general target and the same general stop and just an entry that's just slightly shittier, it means that you can get into essentially what is multiple trades, and then as price continues to go into profit, you can make exponential amounts of profit very quickly. If it goes in a straight line. Now, if it pulls back like it did here, you get a break even on that. You get a break even on the second one. but now you're still sitting in what is essentially the same trade when you zoom out and look at the big picture. And then you can just simply add to it again if it starts going into profit. Move the stop to break even for the previous position. And then if it starts going into more profit, you can add again, all the way up until the trade starts to move maybe about a third of the way to the final target. In this case, it would be about right here, just because that's a third of the way to the final initial profit target. And doing it this way, it allows you to structure the risk in a way that makes a lot of sense without you having to really add a lot of additional risk. But whenever you're right, instead of making 1 unit of reward, it's not uncommon to make 2, 3, 4, 5 units of reward, depending on how many entries you were able to add and depending on what your original risk was. And again, that's anywhere from 2 to 5 units of reward on average for a trade that you maintained 1 unit of risk on. This is to say that if you risked $1,000 on a trade and you made 3 times that, you would have made $3,000. But that's if you were to get your $1,000 stop loss hit, right? Oftentimes it'll be maybe a fourth or a half of the way to the stop loss, and sometimes even break even if you're able to get out at break even, given the fact that you don't think a trade is going to work anymore. It works beautifully for the simple reason that the risk is structured with 1-to-1 going into the trade, but that if the trade starts to win, the trade is added to, so you make more whenever you do win. And then if the trade starts to go into loss, not only do you just not add to it in loss, but you also essentially just try to get out of the trade early. So that means that your losses are relatively small compared to the relatively larger winners. And if you simply make more on winners than you lose on losers, it works perfectly fine. Now, it's better to start with a set it and forget it approach, and then it's better to perform hands-on trading, adding to winning trades, adjusting stops, things like that, after you get more experience. I'd say perhaps 6 to 12 months of experience, seeing just trades hit stop loss or profit targets over and over again with a 1-to-1 risk-reward ratio. There is no shortcut to gaining the experience that generates the intuition, discretion, and wisdom you'll need to trade profitably. As a manual trader, you really have no objective edge. Your edge is just purely subjective. It is based on you using price action discernment and your subjective judgment to determine what is the best thing to do given the context and given that trade. There's no other way to get this, I'll say it again because it's so important, except for just getting experience. You have to get that experience because if you try to shortcut it, you will not have experience that is justified or has any sort of merit. You will just be quite literally flipping a coin, and your trading career is likely going to end over the course of a year or two in failure. So take the time to get that experience, and then you can get more into, quote, hands-on things, like adding to winning trades and adjusting stops and things. Number 5, is it good to hold trades over the weekend and risk volatility, or is this more of a hell no kind of thing? If it's a swing trade, then it's perfectly fine to hold over the weekend. If it's a trade, whether it was a swing trade or maybe a shorter time frame trade, and it's very close to the stop loss or profit target, I'll generally close those before the weekend, just because you don't have to worry about additional fees such as swaps, and you don't have to worry about potential gaps. But if it's a higher time frame trade and it's really far away from the stop or target, and the trade was structured based on the higher time frames like daily, 4 hour, I'll generally hold it over the weekend. It's perfectly fine. Number 6, if you can get in on a trend near the start, what's the max amount of time you should hold the trade? I'll put this question to rest very simply. There is no max amount of time you should hold the trade. So let's say, for example, you happen to get into a trade that for an entire year continues ripping in one direction. And then you just keep moving, like every single week, you end up moving the stop loss closer and closer, and it just doesn't stop. The max amount of time you should hold that trade really just kind of depends on the context. Now, I'll give you the context for me. Most of my trades don't last more than 2 weeks if it's a swing trade, right? That is to say that most of my trades I'm out of at either a loss or a break even or a profit within a week or two. Every now and then a trade will go on past that, but it is very rare and they are few and far between. Perhaps 5% of my trades might last longer than 2 weeks, and not even by much. Perhaps it's only 3 weeks or 4 weeks, but that's just the nature of swing trading. The daily candles only paint 5 new ones per week, and it's not uncommon for 10, 15, 20 new daily candles to form, since there's only 5 days in a trading week, and for it to take 2 weeks to a month. So the max amount of time you should hold the trade for If you're holding the trade for 50 years, you probably could have structured things a little bit better, but there really is no max amount of time you should hold each trade due to the subjectivity of it. 7. Does aggressively adding to winners work with swing trading? The answer is a cataclysmic yes, it does. And it actually works very well. And it works a lot better than trying to do it whenever you're, quote, scalping. That is to say, just trading on lower time frames. Aggressively adding to winners works with swing trading in the Forex market in particular, because when you're looking at the higher time frames, you generally have a lot wider stops. And if you're structuring in the way that I was showing you with my answer to question number 4, then what that means is that you have plenty of room to add to winners. So it works really well, and you can move the stops to break even, and then usually the spreads and everything is not going to take you out as much. Last question, is it better to scale into trades starting with a smaller lot size and increasing your lot size as you open new positions? Or should you generally stick with one lot or 1% of your account when opening new trades? I generally risk a percentage per trade. This is just personal preference. You could choose 1%, 2%, 5%. In my case, I do about 10% of the account risk per trade, just because I know if I'm wrong, I'm probably only going to lose anywhere from 2 to 5%. And I'm okay with that risk because it's not all my trading capital in one account. And it also allows the account to grow just a little bit more quicker and optimally. It really depends on what your average consecutive losing streak is. If you get losing streaks of 20 trades in a row all the time, it's probably better to not risk any more than 0.5% to 1% per trade. If you don't have that many consecutive losing trades, like say you only have 3 or 4 at a time, then sure, perhaps you can risk a higher amount, like 5 to maybe even 10% per trade. It just kind of depends on your stats and metrics. I would say start with risking a percentage of the account per trade, and even as you open new positions, use your account balance as the reference, not the equity, because the equity could all come back and stop you out at not only break even, but perhaps even a loss. But whatever's in the account balance at that given time, that's what I would base the trades are, is depending on what the account closed balance is. So I hope this answers the question for you, jury, as well as the rest of you guys watching this. I'm going to go get my futures day trading started, and I will see you guys in the next video. I'm also starting an email list for those of you who have made it here to the end of the video. I will put a link to join this email list, which is essentially going to replace the Telegram channel. I just prefer to take my time to write things out in an email than just post in Telegram all day. But in the email list, you can click we'll put a link in the description here in the next day or two, maybe even in the pinned comment, and you can subscribe to the email list. And the only promise is that I'll just send you an email like just about every day to try to help you in your Forex trading. And that's it. So if you'd like to join that, just check in the pinned comment or the description here in the next few days. I will see you guys in the next video. Thank you for watching, and I'll see you.